My name is Mensa Isaac and you are welcome to Grade 8 Tutor. Today we are going to introduce ourselves to accounting. Good. So we are going to look at the types of accounting, financial accounting, account, the accounting equation, the financial statements, the elements of the financial statements, and some accounting concepts. Good. So we'll start with the types of accounting. We have three main types of accounting. We have the financial accounting, we have the cost accounting, and we have the managerial accounting, which we are going to focus on the financial accounting. Good. So when we talk about financial accounting, it's a system, okay, a system of maintaining a system, okay. Financial accounting is about maintaining a system of accounting records for business transactions, okay, and other financial and other items of a financial nature, and reporting these business transactions, reporting the financial position and the financial performance of the entity in financial statements. Okay, we report the financial performance and we will report the financial position of the entity in a set of financial statements. Good. So first of all, we will maintain a system which is going to record um, business transactions and other items of financial nature. Okay, then after that we report the performance of the business, how the business is performing, and the position of the business, okay, in a set of financial statements. Good. We can also say that financial accounting is a system by which the economic information of an entity's activity is identified. So first of all, it's identified, measured, recorded, and summarized so that it can be communicated to users for decision making. So this is a system, okay, by which the economic information, okay, of an entity, the activities of the entity is identified. First of all, we have to identify the activity of the entity, okay. Then we'll measure it, monetary terms. After we record it, okay, it's about recording. It's mostly about recording, and we'll summarize it so that it can be communicated to users for decision making. Good. So first of all, we said recording. Where are we going to record these activities? In the accounts. Do you get it? So now, what is an account? An account is a specific ledger that is used to record business transactions. Do you get it? So a typical account looks like this. This account is what we are going to use to record business transactions. Okay, so let's dive a little bit into this account. The account will contain the account name, the date, and the particulars, and the amount involved in the transaction. Do you get it? Good. So for a typical account like this side is what we call the debit side, okay? And this side is what we call the credit side. Good. So in accounting, when they say debit the account, they are trying to say that record the entry at the left side of that account. When they say credit the account, they are trying to say record the entry at the right side of that account. Please do get it. Good. So that's for the account. So the account involved, you write its name. Do you get it? So now you have to understand that the double every transaction um, every transaction involves two items. Do you get it? So if let's say we say sold goods to Ama, we know that when we are selling goods to Ama, we definitely are going to receive cash. Good. So sold goods here is sales. Put it in mind, sales. So now we are going to name this one sales account. The transaction here is between sales and cash. Do you get it? So now, as I said, every transaction is between two items and sometimes more. Good. So now for this, we have sales account. So that's what we are trying to see. The sales account, this is the account for the sales. And we also had another account involved, which is cash account. Okay, good. So you see the transaction is involving two accounts. Good. So that's what you are trying to say. For the double entry principle, the double entry rule, every account, every transaction involves two accounts. And also, for every debit entry, there's a corresponding credit entry. And for every credit entry, there's a corresponding debit entry, which we'll dive more into that. Now let's move to the accounting equation. Now this is the accounting equation. Assets equals capital plus liability. Good. So this is the accounting equation. Now, we already know how to deal with change of subjects. Now, for assets, you have to add the capital plus liability. Now, if you want to get our capital, we are just going to subtract liability from assets. So it's going to be assets minus liabilities is equal to our capital. Do we get it? Good. Now we want to find liability. We just have to bring the capital here. So we have assets minus capital is equal to liability. Good. So this is our accounting equations. Good. So this has to be in your head because it's an essential part of accounting. Very crucial, very important. Good. So these are the accounting equations. Now, financial statements. Financial statements. We have 5 financial statements. We have the statement of profit or loss. This statement is used to determine the financial performance of the business. How well is the business performing? Okay, good. So we prepare this that statement, which is the statement of profit or loss, which is also known as the income statement, to know how well the entity is performing financially. Good. Then we have the statement of financial position, which is also known as the balance sheet. Good. So this statement is used to determine the position of the business. So with a statement of profit and loss, they consist of the expense and income. While the financial statement consists of the accounting equation, which is the assets, capital, and liability. So it shows our total assets, capital, and liability. So this statement of financial position helps us know the position of the business within a specific period of time. Okay, same applies to the statement of profit or loss. It helps us to know the performance of the business within a specific period of time. Good. So we'll come back to explain these terms. Now we have statement of cash flow. Okay, that statement is used to determine or show the cash inflows and outflows of the organization. How cash moves into and outside of the organization. Good. That's simple as that. Then we have statement of changes in equity. So this statement is used to know how the equity of the business changes within a specific period of time. Good. We also have supplementary notes, the additional information and the rest. So we'll be focusing on the statement of profit or loss and the statement of balance sheet, statement of financial position, sorry, for now. Good. Now we have elements of financial statements. Elements of financial statements. Good. So with the elements of financial statements, we have our assets, our equity, which is the same as the capital, our liability, our expense, and our income. Good. So we are going to explain these one by one. Assets. Assets are the economic resources that have the right or potential of providing us with economic benefits. So assets, they are our resources. They are economic resources that has the potential of providing us with economic benefits. Simple as that. Good. So under the assets, we have non-current assets and we have current assets. So the non-current assets, they are resources that provide us with benefits beyond a year. Okay, so we benefit for it more than a year, from it more than a year. Good. And the current assets, they are resources that provide us with economic benefits within a year. Okay, good. Or that can be converted into cash easily. Those are the current assets, the cash and cash equivalents. Good. When we talk about cash equivalents, they are those items that can be converted into cash quickly within mainly 90 days. Yes, specifically 90 days. Good. So we have the asset explained, which we said is an economic resource that provides us with economic benefits. And under it, we have the non-current assets and we have the current assets. Good. So non-current assets, examples are furnitures, buildings, office equipment, investments. You get it? So motor vehicles and the likes. So you can see that these items that I've mentioned provide us with economic benefits. They are resources and they have the potential of providing us with economic benefits beyond a year. Do you get it? Good. Then we have the current assets, which examples are inventories, trade receivables, um, income or owings, expense prepaid, cash, banks, and the likes. Good. So you can see that these items or resources provide us with economic benefits within a year. And as I said, they can be converted into cash easily. Okay, good. So if I have inventory, I can just sell it for money, for cash. Do you get it? Those are the current assets. Now we have equity. Equity is the residual interest in a business, okay, that belongs to the owner or owners after the liabilities are subtracted from the assets. Do you get it? So we said in the accounting equation that assets is equal to capital plus liability. Do you get it? And we are saying that equity is the residual interest in the business, okay, that belongs to the owners after the liabilities are subtracted from the assets. Good. So let's see what I'm trying to say. Assets minus the liability is going to give us our capital, which we also know that it is called equity. Good. So we are trying to say that it is the residual remaining interest in the business that belongs to the owners. It belongs to the owners. That means that the business is liable to pay its owners for that amount. So the equity is the interest, the residual interest that belongs to the owners after the liabilities are subtracted from the assets. You get it? And the accounting equation says it all. Good. So we are moving. We also have to know that equity or capital is the money that the owner introduces into the business, okay, or is any item that the owner uses to start its business or the operation of its business. It can be motor vehicle, not only cash or money. Do you get it? It can be any other assets. Good. So we have equity explained. Now we are moving on to liability. Liability is the financial obligation that the business has no practical duty to avoid. Do you get it? It is the financial obligation, in simple terms, it is the financial obligation that the business has to settle. Okay, that means the business is owing and has to settle. Simple. Get it? They are the amount that the business is owing and has to settle. Good. Under the liability, we have the non-current liability and the current liability. Okay. So for the non-current liability, it is payable beyond a year. Okay. You can pay it. It's a long-term liability that you have to pay in the long run. You get it? So with the non-current liability, we have loans and mortgages and the likes. Good. And under the current liability, these are the obligation that is payable within a year. You have to settle it within a year. Good. And under the current liability, we have the bank overdraft. We have the expenses accrued. We have the income prepaid, trade payables, and the likes. Good. Then we move on to expenses. Expenses, as you know, is in simple terms, they are things or activities that takes money out of the business. Okay, so let's go to the definition. The expense is decrease in assets and increase in liability. Okay, so expense in simple terms we will say it's an increase in liability and decrease in assets, which results to a decrease in equity. Good. So if you want to understand it in simple terms, it's just any activity that is taking money out of the business. Okay, good. As we are operating the business, we have to incur some losses. Money has to go out of the business. Do you get it? So those money that is going out is what we term expenses. An example of the expense is purchase. When you purchase money, because you want to purchase something for the operation of the business, and as a result of that, you incur some an expense. Okay, as a result of the purchasing. Good. So we have income. So income is let's move to revenue first. Revenue is sometimes treated as income, but they are not the same. Revenue and income is not the same. It's similar but not the same. So revenue is like the total income that you earn within a specific period. Okay. So revenue is like the money that comes to you within a specific period. Then the income is like your revenue minus the cost of operating the business. That's the income. That's the money that is for you now. Do you get it? Good. Because at the cost of operating the business, you incur some costs and losses. So the money that you receive during the year, which is the revenue, to get your income, to know your income, you have to subtract that cost of operating the business from your revenue to get the income. what you've earned now. Good. So income is an increase in assets and a decrease in liability, which results in an increase in equity. Good. So we are going to show how these elements are treated. Good. So for assets, when assets increases, you are going to debit. And as I said, the debit is the left side of the account and the credit is the right side of the account. So whenever we see that the transaction that has taken place is increasing the assets involved in that transaction, we are going to what? Debit. So for assets, when they increase, we are going to debit. Now, when the assets involved in that transaction decreases, we are going to credit that asset account. Okay, so as we said, assets are the non-current assets and current assets, which we have the non-current to be furnitures and the like, and the current to be cars, banks, and the like. So whenever these items under the assets decreases, when it's involved in the transaction there and it decreases, we are going to credit that account. Okay, because it's an asset. When it decreases, we have to credit. But when it increases, we have to debit. So I'll cite an example. So let's say bought furniture, okay, with cash. So we bought furniture with cash. That means that the asset involved here, you should know the asset. So if you don't know that furniture is an asset, then you won't be able to identify or you won't be able to know how to treat the item. Do you get it? So you first have to know what item is involved there. Is the item involved there an asset, expense, liability, equity? Good. So now the item involved here is furniture. And we know that furniture is a non-current asset, which means it's an asset. So what is happening to furniture? Furniture has increased. So first of all, let's say we had zero furniture, zero amount of furniture there. Now we've bought furniture. What is happening to our furniture? It has increased. Do you get it? So since it has increased, we are going to debit that furniture account. So let's say we had furniture. So just write furniture account, which you know this is a typical account. So after that, we know that furniture has increased. So we are going to what? Debit furniture. Increase in assets, you are going to debit. So what was the other account involved? It was cash. Bought furniture with cash. Good. So now we have to know what is cash. Is cash an asset, liability? Because if you don't know, you won't be able to treat the account or the item. Do you get it? So you first have to know the account involved. Is the account an asset? Which part of the which element does the account or item involved falls under? Whether an asset, liability, income, expense, or whatever. Good. So you have to know the account, the elements the account falls under. Good. But we know that furniture here is an asset, cash is an asset. So what are we going to do? Furniture increased. So we record here in the name of the in the furniture account in the name of cash because it was involved in furniture and cash. And if you remember, I said for the double entry principle, for every debit entry, there is a corresponding credit entry. So since you've seen that this account, this transaction was involving this and this account, you know that definitely, even if you are able to identify one item where it's going to be recorded, definitely you know where the other item is going to be recorded. But let's dive into the explanation. So you know that furniture has increased. Cash is also an asset that increased. Cash is an asset that decreased because we bought the furniture with our cash. So let's say we had 50 cedis amount of cash. Then we bought the furniture with that 50 cedis. We have no cash anymore. Or let's say we bought the furniture with 40 cedis. Now we are left with 10 cedis. Do you get it? So the cash here has reduced. You get it? So since it has reduced, we know that for assets, when they decrease, they are going to credit. So even without trying to understand everything, you should know that for every debit entry, there is a corresponding credit entry for that transaction. Good. And we said that the transaction involves two accounts. Good. So with this, so if there is any amount given, let's say we bought furniture with cash. Let's say 100 cedis. Let's say 100 cedis. So we record here in the name of cash and the amount here, and you have your Ghana cedis here. You get it? Then when you come here, you know that, oh, cash has decreased. Therefore, I'm going to credit because it's an asset. So when I come here, my Ghana cedis is here. It depends on the currency sign they will give you. So when I come here, I'm going to record here in the name of furniture. So furniture account. So furniture account with that same amount, 100 cedis. Do you get it? This is what we are trying to see. So you should know, this should be in your head. Debit, increase in assets, you debit. Decrease in assets, you credit. Good. So these are some examples to know. Good. So we have equity, which you know that is any amount introduced by the owner into the business. Good. So with equity, let's say started a business with cash. Okay, we started a business with cash. Started a business, we know that for capital is something that the owner has introduced into the business. So come to think of it, let's first of all, so for increase in equity, we have to credit, and decrease, we have to debit. You get it? Good. So first of all, there was no money introduced into the business. So there was no item, or we had nothing introduced into the business. And now the owner has introduced something into the business. That means our capital has increased. Do you get it? So whenever the owner introduce or inject money into the business, that's what we term as the capital. And now the capital here, so started business with cash. Started business. That means we are just going to open our capital account. Simple as that. So since you know that sales goods sold goods, so also sales, generally sales. So we also have to know that started business, you should know that it's capital. Simple. So with the capital account, with this transaction, their accounts involved here are capital and cash. Okay, so started business with cash. We have the cash here. So making it simple for us to understand. Good. So with the capital, we know that when the capital increases, we have to credit. Okay, we have to credit. Good. So now capital has increased. So what do we have to do? Even if we don't know that capital has increased, by all means, we should know what has happened to either of the accounts involved. Okay, so if you are not even able to figure out capital, what is the other account involved? It's cash. Do you know what has happened to cash? If you know, you record it there. Then you know that for every corresponding, there is a corresponding entry too. You get it? Good. So now we have our capital to increase. So our capital has increased now. Let's say you started a business with um, same 100 cedis. So for increase in our capital, we are going to credit. Started the business. Okay, let's say there was an issue amount of 10 cedis. Now you've injected another amount. Hasn't it increased? The capital has increased. Good. So now when the capital increases, we are going to what? Credit. And cash here has also increased. So let's say initially we had 10 cedis now. um, as cash. We had 10 cedis cash, and now you've introduced another 10 cedis into the business. What has happened to cash? 10 plus 10, 20. It has increased, right? Good. So increase in cash, we are going to debit because cash is an asset. So you have to know the account, which element it falls under. So cash is an asset. So we are going to debit because it has increased. So when we come here in the name of the capital, because it's involving these two accounts. So when you come to this account, you are recording the corresponding account name here with the amount. So when you come here, it's going to be capital with the 100 cedis. So we started the business with cash, 100 cedis. So this is how you are going to treat it. So for capital, when they increase, you are going to credit. When they decrease, you are going to debit. Good. So with capital, we have to know that there are some items that affect capital. Okay. For capital, the items, typical items that affect capital, we can say profit, okay, drawings. Good. So now we've introduced money into the business. We are operating our business, our day-to-day operation. Now we've gotten profit out of the money we introduced into the business. It will add up to our capital. Do you get it? Because from the capital that we use to operate the business, and now we've gotten some profit out of it. So the profit adds up to the capital. Do you get it? Good. So when you have a typical account like this, you are going to see that since when there is an since if there's an increase in capital, you know you are going to credit. And we know that for profit, it's going to add up to our capital because from the money we introduced, we've received a profit. Okay, so it's going to add up to the money we have. So that means when the capital is increasing, we have to credit. Good. So let's say typically we are going to see the profit here because it's increasing our capital. And the drawings is something that the owner has taken out of the business. Okay, he has removed out of the business. We are operating our business and he has removed an amount from the business for his own personal use. You get it? So it's going to reduce the capital. It's going to reduce the amount that was introduced into the business. So for understanding, let me do it like this. So for the capital was introduced, let's say 100. Good. And the business owner has come again to take away 50 cedis from the business. You've introduced money into the business. Then you've come back to take money out of the business for your own personal use. Good. So that one is going to decrease our capital. And we know that for decrease in capital, we are going to what? Debit. Good. So typically, we are going to see it like this. Do you get it? Whilst the profit is increasing the capital, the drawings is also what? Decreasing the capital. And we also have losses. Loss. Loss also decreases our capital. So let's say we introduce money to the business and we are expecting profit and we don't get a profit and we get a loss. It has decreased our capital. Do you get it? So typically we also see loss here. Good. So as profit is increasing our capital, loss will automatically decrease our capital. So it's either we get a profit or loss. Good. That's for the capital or equity. Now we move on to liability. So for increase in liability, we are going to credit. And for decrease in liability, we are going to debit. Good. So for liability, let me cite an example. Sold goods to Ama on credit. So now, purchase goods from Ama on credit. Now we know that liabilities are financial obligations that we have to settle. Okay, we have no practical duty to avoid. you have to settle by all means. Okay. So we've purchased goods from Amma on credit. On credit, we've not paid for it. Good. So that means that Amma has become our liability, something that we have to settle. Do you get it? So Amma here is a trade payable, which you know that trade payable is a current liability. Current liability is a liability. So trade payable, the account involved here is trade payable, okay, which is Amma. Amma is the trade payable here. So we have to take note of all these. Good. So the people the business owes are trade payable. Simple as that. The people or persons or businesses or organizations that the business owes are trade payables. Good. So now, purchase goods from Amma on credit. Now, if purchase goods from Amma on credit, we know that as sold goods is sales, purchase goods will what purchases. So the accounts involved here are purchases and what trade payables. Do you get it? Good. Now, trade payables. First of all, if we do not go and purchase anything from Amma, do you think we'll be owing Amma? No. So since we've gone to purchase something from Amma and we are now liable to settle our debt. First of all, we had zero amount to pay Amma. Now we've gone to purchase something on credit from Amma. So that means that our liability has increased. Do you get it? And you know that for increase in liability, we have to what? Credit. Do you get it? Good. So we have to credit. That's for increase in liability. Good. So the account involved here is purchases. So take note. Sold goods is sales. Then purchased goods is what? Purchases. So unless maybe the transaction specify is specific that maybe purchase motor vehicle. For purchase motor vehicle, as you are going to open motor vehicle account because it was specific. But when it says purchase goods, it's purchase. You get it. So purchase motor vehicle, you are going to use that motor vehicle. Purchase any other items apart from goods, you are going to use that account to represent the account. Good. So we have trade payables here and purchases, which are the two accounts involved. And we know that our trade payable has increased. We should know what trade payable falls under which elements of the financial statement. And we know that it's a liability. And when our liabilities are increasing, we have to credit. Just put these in mind. Good. So when our liabilities are increasing, we have to credit. Which account was involved here? Purchases and trade payables. So whilst you are crediting in trade payables, you have to credit in the name of purchase because it was involving these two accounts. Yes. Now purchases here is an expense. Okay, it's taking money out of the business because we have money. We're going to use that money to purchase something. Money is gone. Do you get it? So increase in these purchases, which will come to it. Increase in expense, you have to debit. Okay, you can see that our expense has what increased. You get it? So even if you don't know the corresponding entry for purchases, you should know that for every credit entry, there's a corresponding debit entry. So now we've been able to identify one account where we are going to record. Then when we know that, oh, then we are going to debit the account. Do you get it? Because if it's involving two accounts, you should know that for every credit entry, there is a corresponding debit entry. And if there is any debit entry, there is a corresponding credit entry. Great. So for purchases, we've recorded the trade payable in the name of purchases. Then when we come to purchases, we record the trade payable here. We get it. So let's use the same 100 cedis. Good. So I hope you see it's a different account. So let me make it like this. Good. So we know that expense has increased, money is gone out. Trade payable has also increased because we are now liable to settle a debt. Okay, so increase in our liability, we have credited. Then increase in our expense, we debited. Good. So when there is a decrease in our expense, we are going to credit. Simple as that. Please, you get it. Good. Okay. So we are going to income. So as we know that income is an increase in assets and decrease in liability, resulting in an increase in equity. So in simple terms, their money or their is when money is coming into the business. You get? Yes. For the understanding, you have to know that it is when we are receiving the money. You get it? Good. It's similar to the revenue. Good. So we have income. So whenever income increases, we are going to credit. Whenever income decreases, we are going to debit. Do you get it? Good. So when the income increases, we are going to credit. When the income decreases, we are going to debit. So an example, discount received. So discount received, we know that we receive discount from our trade payables, okay, or those who sell to us, okay. They are those the people who are going to give us discounts, okay. Good. So discount received, account. So we know that trade payables account will also be opened because you have to know people, the person who is going to give you that discount, who is going to yes, give you that discount. Good. So this transaction, the account involved is discount received and trade payables. Good. So discount received, and we know that when our income is increasing, we have to credit. Good. When our income is decreasing, we have to debit. Now, initially, did we have any discount received? No. And even if we had, now we've received another one, which is going to increase our discount. So if we didn't, zero. So let's say we received a discount of 50 cedis. 50 plus 0 is 50. Then we've increased from 0 to what? 50. So whenever our income is increasing, we are going to credit. Do you get it? Good. So with this account, you could see that the income here. So first of all, you have to identify which element the account falls under. You get it? So we know that discount received is an income. Therefore, when it has increased, we have to what? Credit. Good. So discount received, we are going to credit here in the name of trade payables. So then let's say the account involved here, the amount involved here is 50 cedis. So even if I don't know this, I know that for every credit entry, there's a corresponding debit entry. Therefore, I have to record here. Okay. So let's go to the understanding. Trade payable, you should know that is a what? Liability. What has happened to trade payables here? You should know that when there's a decrease in trade payables, which is a liability, we are going to debit. When there is an increase, we are going to credit. Now, there has been a decrease because these people are the ones we owe. And these people who have given us discount, we know that discount received is from our trade payables. You should know that the people who sell to us, because they sell to us for us to owe them, because if they sell to us on credit, they are trade payables. And now these people have given us discount. Okay, so if we are owing them 100 cedis and they said they've given us discount 50 cedis. What has happened to the amount we are owing? It has decreased from 100 to 50. So now we are owing 50. So decrease in this trade payables, we are going to debit because it's a liability. Good. So we have to know that the account involved here is discount received and trade payables. So as we are crediting discount received because it has increased and because it's an income we have credited, then when we come here, trade payables, we should know that our liabilities, our debt, or the amount we owe has also decreased because we received discount. Okay, so as we receive discount, we are going to debit because our liability has now decreased. So we will record here the name of discount received. The amount involved here is 50 cedis. Please do get it. Good. So now we are moving on to, we are done with the element of financial statements. We are moving on to some accounting concepts. Good. So we have many. So I'll talk about just three. So we have going concern, which says that the business will continue to exist for the foreseeable future. Okay, so we assume that the business is what going to exist beyond a specific period. Good. And we also have the business entity concept, which says that the business is separate from its owners. Okay, so these are some of the concepts. So that means that the personal transactions of the owners should not be treated as part of the business transactions. Okay, the business is separate from the owners. Okay, good. That's why we can sue an owner, and sometimes we can even sue a business, not an owner. You get it? So this should say that the business is what separate from the owner. So that means that any business transaction should not be treated as if it's the owner's personal transaction. That's why when the owner withdraws money from the business, we deduct from the capital because it's a separate transaction on its own. Do you get it? Good. Because when we check, let me give an example. We have the capital here. We know that the things that affect the capital is drawings and profits, losses, and the likes. So let's say the business, the owner pays for his children's school fees or does some personal transaction. That transaction should not be treated as part of the business transaction. Do you get it? The business has its own transaction it operates on. Okay, so if the owner is somewhere doing his own transaction, that transaction should not be treated as part of the business transaction. So therefore, the business entity concept is that the owners are what? Separate from the business. Do you get it? Good. And we have the accrual basis. So the accrual basis tries to say that it's items, okay, or financial transactions are recognized when they occur, okay, and recorded in the financial statement to the particular period they relate to. This is what it's trying to say. The financial transactions or items, okay, are recognized when they occur. So that means that it is not that we recognize it when the money or cash relating to that particular transaction is received. Okay, we recognize it when they occur. So let's say you work, let's say they are workers working for our organization. We are supposed to pay them salaries. Okay, for that particular year, we are supposed to pay them salary. So let's say 1 cedi per month. Okay, then we have 12 cedis per year. We are supposed to pay them 12 cedis per year. Good. So for that year, we didn't pay them. When we are recording, we are going to record the 12 cedis. Even though we didn't pay them, we are going to record the salary as an expense. Even though we didn't pay them their salaries. Do you get it? Because they have worked and they have to be paid, but we've not given them the salary. But for that particular year to which the event occurred, we have to what? Recognize that transaction and record it. It is not when the amount or money relating to that particular transaction has been received or paid is when we are going to record. When it has occurred, even without payment, or we've not received it, we are still going to record the event or transaction. Do you get it? So that's all about the accrual basis. And accounting is prepared on the accrual basis most of the time. So all what we'll be doing will be based on the accrual basis. Okay, that's why when we sell on credit or purchase on credit, we still record it, even though we've not received the amount or paid the amount. Do you get it? Good. So that's all for introduction to accounting, and I hope you've learned a lot. And so this thing has to be in mind. These things have to be in mind. Very important. You have to know what happens when the elements increases or decreases. Good. So that's all for now. My name is Mensa Isaac, and this is Grade 8 Tutor. Please make sure to subscribe, like, comment, and share. Thank you very much. See you in the next video.